Hello, this is Sal Guatieri, Senior Economist, BMO Capital Markets. Surprising no one, the Federal Reserve kept policy steady on April 27th for a third straight meeting. Importantly, while it kept the door open for a possible rate hike at the next meeting, it made clear that higher rates will only occur if the U.S. economy strengthens and policymakers become more comfortable with global and market risks. Barring an inflation surprise, the Fed will remain patient and cautious when normalizing policy, for fear of jeopardizing the expansion. We expect no more than a couple quarter-point rate hikes this year. So what does a slowpoke Fed mean for the economy and markets? The mild tightening cycle is clearly good news for the economy. Nearly every recession in the post-war era was caused by sharp interest rate hikes to suppress inflation. Gradual tightening this time would greatly reduce the chance of recession. Alas, the reason the Fed is moving slowly is because the economy is also, putting it at less risk of overheating. 2% is the new 3% for U.S. growth. However, because the economy is already near full employment, moderate but sustainable growth is not a bad thing. An expanding U.S. economy will support corporate earnings and equity markets. It's also a godsend for the Canadian economy, struggling with lower resource prices. As the economy recovers and joblessness falls, the Bank of Canada will begin to raise interest rates too, but likely not until well into 2017. Fed tightening should help the U.S. dollar retain earlier gains, keeping it near 13-year highs on a trade-weighted basis. This means the Canadian dollar, now up 16% from its lows of earlier this year, will struggle to make further headway in the face of negative interest rate spreads with the U.S. We think the loonie will remain below 80 cents U.S. for a while, cheap enough to support Canada's economy. It will advance next year, however, as oil prices recover further. Higher U.S. interest rates will weigh on one asset, bonds. The lofty capital gains on government issues as rates fell in recent years will likely come to an end. Still, pensioners and investors who rely on a stable source of returns from fixed income securities will finally get some relief, though it could take a couple more years before long-term interest rates are a couple percentage points above current depressed levels. Housing markets, the most interest-sensitive part of the economy, will benefit from still low interest rates this year. However, sales in the high-priced Vancouver and Toronto markets could weaken next year if the Bank of Canada tightens policy, as affordability for detached homes is already stretched thin. To wrap up, the subdued outlook for Fed policy is good news for the economy, real estate, and stock markets, while bonds and the loonie could underperform modestly. Even if the Fed raises rates a couple times this year, it shouldn't slow the economy much, let alone trigger a recession. We probably won't need to worry about the economy striking out until the Fed is in the late innings of a tightening cycle. Thanks.